Hello everyone, this is Jim Lucy, Editor-in-Chief for Electrical Wholesaling and Electrical Marketing. I've got a special report on the economic impact the COVID-19 coronavirus is having on the electrical market. In today's presentation, we'll explore the latest weekly economic indicators through the third week of April. You can use them to get a sense of where the electrical economy is headed. One of the many challenges electrical distributors, manufacturers, and reps are facing in this crisis is finding timely economic data that offers an early indicator of where the market may be headed and when and where any economic turn for the better may be occurring. Local employment data for your electrical contractor and industrial customers, value of new construction, and building permits lag the market by at least 4 to 6 weeks. The editors of Electrical Wholesaling and Electrical Marketing believe we found a solution. Over the next 10 minutes, I'll discuss the latest data for some key weekly economic indicators you can watch to take the pulse of the electrical market. We'll be providing these updates every 2 weeks. These weekly indicators are the initial unemployment claims at the state level, rail freight car traffic, the Baker-Hughes Rig Count, oil prices, and copper prices. This week we've got 2 added bonuses, the consensus construction forecast from the American Institute of Architects and a sneak preview of some key findings from our top 200 survey from more than 40 early responders. Employment data from the U.S. Department of Labor and the U.S. Bureau of Labor Statistics highlights the states with the highest proportion of unemployment claims so far in the COVID-19 crisis. We took the data and converted it to claims for 1,000 workers in the state's labor force so we could compare states of different sizes. The data is valuable to distributors, manufacturers, and reps because it offers empirical evidence of just how big an issue layoffs are now at the local level. On a more positive note, when these claims start declining and establish a trend in this direction, it will be a clue for you about when the economy in that state is starting to improve. For the week of April 18th, the most recent data available, West Virginia led the nation with 57 unemployment claims per 1,000 workers in the labor force, followed by Connecticut with 54 claims, Kentucky with 51 claims per 1,000, Florida with 49 claims, and Georgia with 47 claims per 1,000. Of the nation's nearly 4.3 million claims submitted for the last week, California led the nation with more than 500,000 claims, or 13% of the nation's total. Other states with particularly huge amounts of unemployment claims for last week included Florida, with over 500,000 claims, Texas, with 280,406 claims, Georgia, with 243,677 claims, and New York, with 204,716 claims. As you analyze the list, you'll quickly note that just 10 states listed here account for 57% of the nation's total. In addition to those states mentioned, you've got Pennsylvania, New Jersey, Michigan, Ohio, and North Carolina. An interesting leading indicator for the overall U.S. economy is freight rail traffic because it's a measure of the amount of raw materials and finished goods being shipped by rail. The best source for this data is the American Association of Railroads, which publishes this data weekly. Let's take a look. According to AAR, for the week ending April 18th, total freight traffic was 198,598,000 carloads, which is down 27.5%. Year-to-date freight traffic volume was down 9.5% year-to-date when compared with the same period in 2019. Motor vehicles and parts again led all categories in declines with a massive 88% decline. Last week we heard about Union Pacific had furloughed about 900 railroad workers because shipping demand has been weaker than expected. That's big news in Kansas City, where I'm located, because it's one of the largest freight railroad towns in the Midwest. In this slide, you can see some of the most dramatic declines in freight car traffic on both a year-to-year and year-to-date basis. As mentioned earlier, motor vehicles and parts showing a pretty huge decline, over 20%. Also coal year-to-date showing a 20% decline. If you track the oil market, you're probably familiar with the Baker-Hughes Rig Count, which tracks the oil and gas rigs that are operating. The data is available on a weekly basis on the state, basin, and national basis. The rig count has declined further and faster since our last presentation 2 weeks ago. The number of total oil rigs operating is down 43%, with 361 fewer rigs operating in the third week of April than there were in the third week of April 2019. It's interesting to note how consolidated oil production is in the United States. The Permian Basin in West Texas and eastern New Mexico and the Eagle Ford Basin in Texas account for 70% of all operating rigs in the United States. There's roughly another 10% in the Williston Basin in North Dakota and eastern Montana. That's 80% in just 3 basins. It has also declined further since our last presentation. Because of comparatively low prices and demand for natural gas, this segment of the oil and gas market was fairly slow going into the crisis. The numbers have gotten worse. In total, year-over-year production is down 52%, with 98 fewer rigs operating through the third week of April. The bulk of the operational gas rigs are in the Haynesville Shale play in southwest Arkansas, northwest Louisiana, and east Texas, and then the large Marcellus Shale play in Pennsylvania, eastern Ohio, and West Virginia. This slide gives you an idea of the largest oil and gas deposit. It really gives you a sense of just how many of the large oil plays are in Texas and Oklahoma, and how big an area the Marcellus gas region covers. Oil prices for West Texas Intermediate started the year out around $60 a barrel. We all know how far down they went over the past couple of weeks, with the May, particularly last week, with May futures deep into negative territory. Let's get a historical perspective on oil prices. As you can see in the chart, they were up as high as $70 to $100 a barrel from 2007 to 2008. It's hard to believe now. As we mentioned in the last presentation, the break-even price per barrel of oil varies quite a bit by basin. Companies operate much more efficiently than they had in the past, and this has driven prices down quite a bit from where they can make money. 2018 post on www.oilprice.com said the Eagle Ford breaks even at around $48 to $61 a barrel, the Bakken at $53 to $56 a barrel, and the Niobrara at $63 a barrel, where the Permian breaks even around $37 a barrel. I haven't read anything that says the crisis in the oil and gas industry will end anytime soon, or that it will subside as the U.S. gets a better handle on the COVID-19 coronavirus, and or when the U.S. economy slowly starts opening up again. This slide gives you an idea of where oil prices have been just during the last year. At the left side of the chart, you can see where they were in April 2019, held pretty steady at around $60 a barrel before plunging over the past month or so, down to some pretty low levels that really have not been, in some cases, never seen before. Now let's take a look at the copper market. Prices have been down, but perhaps not quite as bad as some other areas and some other indicators in the electrical market. Let's take a look in the next slide. Well, prices have been down 20% year to date and 13% along the last month alone. In the past week or so, they're showing some signs of stabilizing at around the 220 to 230 range. That might be comparatively good news. Let's take a look at another key market indicator that electrical wholesaling editors find useful, the consensus construction forecast published by the American Institute of Architects. It's updated twice a year. It utilizes forecasts from the leading construction economists from 8 firms: Dodge Data and Analytics, IHS Economics, Moody's Economy.com, FMI, Construct Connect, Associated Builders and Contractors, Wells Fargo Securities, and Markstein Advisors. They initially expected a modest slowdown for non-residential business activity in 2020, but they now see some bigger declines because of the COVID-19 coronavirus crisis. Let's take a look at what they say in the next slide. According to the consensus construction forecast, the small projected growth for 2020 has now been revised down to 11% decline overall, with the sharpest decline predicted to occur in the commercial construction sector. Originally, the panel had forecast 0.6% growth for commercial construction. They've revised that down to 14% decline. Institutional construction spending will also be hit hard, although not quite as seriously commercial. Institutional, they're looking at losses of -7% versus what they originally had predicted of 2.9% growth in December. In this slide, you can see where the AIA construction panel is looking for hot spots and areas of slower growth in the various construction sectors. They're looking for the most growth this year in healthcare. They're looking for retail and hotel to lag the market. I also thought you might find some of the economic assessments from more than 40 top 200 electrical distributors to be of interest. They told us what they thought on their local markets might return to some sort of normal. I thought the results were actually pretty optimistic, with 45% of the respondents who have written in so far expecting better market conditions to return in third quarter of 2020. That would be great. Over the years, we found electrical distributors to be very solid forecasters from their surveys in the Market Planning Guide, and they tend to have a pretty good grip on where the market is headed. That ends our report for today. If you're looking for more local economic information, check out electricalmarketing.com. An annual subscription to electrical marketing includes electrical sales estimates at the metro, county, and sales level, electric product estimates for 17 product categories at the state level, and access to a construction database with hundreds of projects that is updated quarterly, as well as building permits at the metro and state level, and other key economic data. An annual subscription to electrical marketing only costs $99 per year at our special promotional rate. The subscriptions include access to all the market data described in the previous slide, as well as electrical marketing newsletter published twice each month. You can get that either mail or digital in a downloadable PDF format. Some of the data that you'll get in the electrical marketing newsletter includes the electrical price index, which many subscribers tell us is worth the cost of a subscription alone. If you're interested in subscribing to electrical marketing, contact Sonia Trent. You'll see her email on the screen here. Thanks for listening to our presentation on the 5 weekly economic indicators to track. Please give us some feedback if there are other indicators that you would like to be including in future broadcasts of these indicators. Thanks, and have a great day.